Entering the financial markets, many traders carry high hopes and ambitions. However, numerous individuals stumble right from the start due to common mistakes that lead to failure. In fact, 90% of traders fail due to these 10 mistakes, and these seemingly simple errors can have significant consequences on both accounts and psychology. In the trading world, relying solely on luck or impulsive judgments can be costly. Successful trading isn't just about seizing buying and selling opportunities on charts. It requires a deep understanding of strategy, risk management, and disciplined decision-making. Those who succeed in this market understand that there are no easy victories or shortcuts to sustainable profits. Recognizing these mistakes is the first step to avoiding failure. The common mistakes outlined below will help you become more confident and wise on your journey to becoming a successful trader. Avoiding these errors not only protects your investment capital, but also builds a solid mental foundation, enabling you to overcome challenges in the volatile financial world. 1. Not defining the risk level for each trade. Risk management is crucial in trading, playing a vital role in protecting capital and ensuring long-term survival in the market. Failing to define the risk level for each trade can lead to unwanted losses and negatively impact a trader's psychology. Before entering any trade, it's essential to determine the maximum risk you are willing to accept. Professional traders typically recommend not risking more than 1 to 2% of total capital per trade. This approach helps to minimize losses if a trade doesn't go as planned and protects the account from significant market fluctuations. Defining a specific risk level for each trade not only reduces stress, but also lays the foundation for a sustainable trading strategy. Knowing the potential loss allows you to make decisions more easily without being influenced by emotions. Moreover, it helps maintain discipline in trading, avoiding impulsive increases in position size after losses. One useful tool in risk management is the stop-loss order. By setting a stop-loss at a predetermined price, you can automatically exit a trade if the market moves against you, thereby limiting losses. Combining stop-loss orders with a well-defined risk level for each trade enables you to better control adverse situations and effectively safeguard your capital. 2. Focusing solely on profit while ignoring entry rules. Focusing solely on profits while neglecting entry rules can lead to significant risks and negatively impact long-term success. Although profit is the ultimate goal, achieving it sustainably requires discipline and adherence to established trading processes. Discipline in trading involves following predetermined principles and strategies without letting emotions dictate decisions. When traders concentrate only on profits, they may make impulsive choices, such as increasing trade volumes irrationally or pursuing unclear opportunities, leading to higher risks. Adhering to the trading process ensures that each decision is based on thorough analysis and aligns with the overall strategy. This approach not only minimizes risks, but also fosters consistency in trading outcomes. A robust trading process includes identifying entry and exit points, managing risks, and evaluating performance after each trade. Focusing on the process rather than just profits helps traders develop deeper market insights and skills. By following the process, they can identify and correct mistakes, thereby improving trading performance over time. 3. Interfering with trades after entering an order. One common mistake traders make is interfering with trades after placing an order. This behavior, known as mid-trade interference, usually stems from anxiety, fear of loss, or a desire to optimize profit. However, adjusting a trade when the market fluctuates often disrupts the entire initial strategy the trader originally established. According to many financial experts, the set and forget approach, setting up a trade and leaving it untouched, is one of the most stable methods. Once an order is placed with clear stop-loss and take profit levels, letting the trade run without interference helps traders avoid emotional influences. Temporary feelings such as excitement when the market rises slightly or fear when it falls can lead to poor decisions that derail the original plan entirely. This approach is particularly beneficial for those who tend to check charts constantly and get caught up in short-term fluctuations. The set and forget method allows traders to focus on long-term strategies rather than being swayed by immediate market movements. It is not only a skill but also a mental exercise, requiring traders to trust their strategy and maintain discipline, thereby building a strong foundation for long-term success in the financial market. 4. Trading with real money before testing on a demo account. Many new traders often make the mistake of jumping straight into the market with real money, skipping the essential step of testing on a demo account. They believe that with a bit of basic analysis or luck, they can beat the market. However, in reality, lack of experience frequently leads to significant losses, resulting in discouragement and loss of confidence in their trading abilities. Starting with a demo account offers a realistic view of the market without the financial pressure. A demo account allows traders to get accustomed to the platform's interface and functionality while safely experimenting with various strategies. This is a wise step to build experience, refine skills, and minimize the risk of costly mistakes when transitioning to live trading. Don't let impatience take over. Take the time to learn and familiarize yourself with the market through a demo account before engaging in real trading. This is the best way to establish a strong foundation for a long-term financial journey. Additionally, when you open an account through our links, you can benefit from an automatic commission rebate program when trading with a real account, helping to save on costs and optimize profits. 5. Feelings of impatience or desperation in trading. Impatience and desperation in trading often lead to impulsive decisions and significant losses. The urge for quick profits can cause traders to neglect fundamental principles, resulting in unnecessary risks. Experts advise maintaining a calm mindset and managing expectations to make sound decisions. Instead of seeking immediate gains, traders should develop long-term strategies based on thorough analysis and effective risk management. Setting realistic goals and working towards them patiently helps avoid psychological pressure. Financial markets are inherently volatile, and there are no shortcuts to success. Understanding oneself, controlling emotions, and adhering to disciplined trading practices are essential for sustainable results. Impatience and desperation can be a trader's worst enemies. Maintaining stability and focusing on long-term strategies aid in making rational decisions, minimizing risks, and optimizing profits. 6. Overtrading. Overtrading occurs when investors execute numerous trades in a short period, often driven by the desire for quick profits or overreacting to market fluctuations. This behavior can diminish investment efficiency and elevate the risk of losses. Experts note that overtrading may lead to impulsive decisions and emotional cycles, from euphoria during gains to fear during losses, resulting in undisciplined actions. To avoid overtrading, investors should focus on the quality of trades over quantity, basing decisions on thorough analysis and clear strategies. Establishing and adhering to a specific trading plan can effectively manage trade frequency. Patience and discipline are crucial in resisting the urge to overtrade, protecting capital, and achieving long-term success. 7. Trading on short time frames. Selecting the appropriate time frame is crucial for informed trading decisions. While short time frames like 1-minute or 5-minute charts may seem appealing for quick gains, they often produce misleading signals due to market noise. Longer time frames, such as daily or weekly charts, provide more reliable insights into overall market trends, aiding in the identification of price patterns and key support and resistance levels. This approach reduces stress, as traders can avoid constant monitoring and insignificant short-term volatility. Additionally, trading on longer time frames fosters patience and discipline, allowing for thorough analysis and careful strategy execution, which can enhance the potential for sustainable profits. 8. Spending too much time watching charts. Monitoring charts excessively can lead to impulsive decisions. Many traders, especially beginners, become absorbed in watching price movements, hoping to catch quick opportunities. However, this habit increases stress and encourages emotion-driven choices over logical ones. Experts suggest taking breaks during trading to maintain clarity. Constant chart watching can make traders reactive to short-term fluctuations, often deviating from their plans and risking unintended losses. Continuous exposure to red, signaling price drops, can also impact psychology, triggering anxiety and prompting hasty sell-offs. To avoid this, traders should follow a clear plan with defined entry and exit points, stepping away from screens to reduce stress. Maintaining a balanced lifestyle through exercise, rest, and recreation further supports rational decision-making, enhancing both trading performance and mental well-being. 9. Being influenced by news. Over-reliance on news can cloud judgment and negatively impact trading decisions. News often triggers emotional responses, leading traders to react impulsively without thorough consideration. It's crucial to recognize that markets typically price in significant information before official news releases. Large traders and financial institutions often act on information ahead of the public, causing price movements that individual traders may only notice after the fact. Reacting to news after the market has already adjusted is akin to chasing a shadow that's already vanished. In this context, technical analysis emerges as a powerful tool, offering traders stability and clarity. By examining price charts, identifying trends, and forecasting optimal entry and exit points, technical analysis helps traders avoid the emotional whirlpool induced by news. This approach not only instills confidence, but also frees the mind from anxiety, enabling traders to develop strategies based on logic rather than emotion. Instead of being swept away by the emotional currents of news, traders should seek insights through market signals, leading to more informed and sustainable decisions. 10. Not recognizing the element of randomness in each trade. Failing to acknowledge the inherent randomness in each trade is a common error among traders. Markets are influenced by numerous factors: economic shifts, monetary policies, political events, and crowd psychology, creating a complex environment where predicting every trade's outcome with precision is impossible. Even well-analyzed, strategic trades can result in losses due to this unpredictability. Recognizing that not every trade will succeed normalizes encountering unfavorable outcomes. However, this doesn't mean leaving success to chance. Developing and adhering to a disciplined trading strategy, defining clear entry and exit points, setting reasonable stop loss and take profit levels, and implementing effective risk management is essential. Such discipline helps traders avoid emotional reactions during unexpected market shifts. Understanding the element of randomness reduces psychological pressure and fosters a long-term, objective perspective. Focusing on the process rather than individual outcomes enables traders to refine skills, improve strategies, and achieve greater stability, building a solid foundation for navigating the complexities of financial markets.